Hi, this is James Shug with Westpac London's end of day report for Wednesday the 16th of November. It was a pretty choppy day on European equity markets today. Some positive sentiment earlier in the session was eroded later on, despite some reasonable numbers out on the US economy. But most of the focus was again on problems in Europe, which were emphasised by the Bank of England governor in his quarterly press conference when he delivered the Bank of England's latest inflation and economic growth projections. Now they've slashed the growth and inflation forecasts for the UK out 2 years. They've mentioned or cited the concerns about the problems in Europe as a big drag on the outlook for UK growth, and noted that they couldn't even quantify the most extreme sort of outcomes that might be conceivable and have a significant impact on the outlook for growth and inflation, but they remained as significant risks to the already fairly pessimistic view that they espouse today. I mean, basically the Bank of England expects the UK economy to effectively stall for the next few quarters before growth slowly starts to recover later in 2012, but that's on the basis of the assumption that the right policy mix is actually put in place in Europe to prevent the ongoing malaise in bond markets and equity markets, and indeed concern about the sustainability of the government debt positions in Europe and about the viability of the banking system in Europe. So that's a pretty important assumption, and one that certainly I think is yet to be proven to be justified. Anyway, so the Bank of England commentary was coincided with and perhaps caused the markets to lose quite a bit of steam. But they weren't the only, that wasn't the only development today. On the data front, we had in the UK, in the third quarter, employment fell 197,000. That more than wiped out the quarterly gains in jobs in the first two quarters of this year. And what it meant was that the unemployment rate rose from 7.9% in the second quarter to 8.3% in the third quarter. And that's another indication of just how the UK economy really has hit a brick wall. There were some one-off factors that helped drive the 0.5% GDP growth rate that was reported for the UK some weeks ago for Q3, but already we're expecting to see that revised down given more up-to-date partial data that we've seen. The US data, as I mentioned, wasn't too bad today. We had a small fall in the CPI for the month of October, and core prices, which were flat in September, rose just 0.1% in October. If the current run of slightly better activity data peters out, as we expect it will, and we get a continuation of these recent more benign core inflation outcomes, then the prospect of quantitative easing, or a third round of quantitative easing from the Fed, I think will engender more support, will gain more support. US industrial production rose 0.7% in October. Autos in particular are a big chunk of that. Housing market sentiment picked up to its highest in 18 months. Still very, very weak, but at least it's not going backwards like housing sales and home starts have been so far during the two years plus of economic recovery in the US. That's about it on the data front. Ongoing shenanigans in Italy and Greece. I mean, there's going to be a confidence vote in the new Greek interim government to give it the firm mandate to pursue the austerity measures that it needs to. Italian bond yields rose back above 7% today because of ongoing concerns about the ability of the Italian new technocrat government in Italy to push through, the reforms that it needs to ensure that the budget deficit is cut sufficiently to convince markets that Italy shouldn't lose access to financial markets. But the vibe in Europe just generally today was one of maybe we got a little bit too optimistic about these new interim governments in both Greece and Italy. So given all that, this is where equity markets stand at the moment. I'm not used to wearing glasses when I'm doing this, so I'm going to take them off. In the US, the Dow at the moment is down about 1/3%, and it's about 430 in London. That means the Dow's at 12,057. In London, the FTSE's down 0.1%. The French market's up 0.5%, and the German market's down 0.3%. All of those markets were performing much more strongly earlier on today, and the US futures market was performing more strongly as well. But as I say, it was the Bank of England commentary that really triggered the renewed sense of concern about prospects for Europe and global growth and so on. On commodity markets today, the oil price is actually up about 3%. We're looking at $102.03 a barrel. There's been some pipeline changes in the US, which has meant that a big glut of oil at the Oklahoma storage depot has actually been freed up. And so that's putting upward pressure on the oil price, given that glut is now being dissipated. The copper price down 0.5% today. Gold price is down 0.6%. We're looking at $1,771 an ounce. The Aussie dollar at 1.014 against the US dollar has traded just over 1 cent range. It was below 101, above 102. It's, as I say, around the middle of that range at the moment. The Reserve Bank Governor, Glenn Stevens, he's making some opening remarks at a conference, so there might be something in there to watch for in Australian trading today. All right, I think that's about it for today. Other than to mention too, for those that watch the French-German spread, rose to 190 basis points today. A couple of months ago, it was at 40 basis points. So that's 1.5% more at the 10-year part of the curve that the French government would have to pay if it wanted to refinance anything for a 10-year term. And that, of course, flows from this idea that just maybe the euro is no longer an irrevocable locking of the currencies of a range of disparate European countries. Anyway, more to talk about tomorrow. I'll be back then.